So what is the story with the global economy this quarter? Well, it's really a tale of three very different paths. We've got one major power absolutely sprinting ahead, another one just kind of treading water, and a third is facing a really curious puzzle. Today, we're going to dig into the latest Q3 report cards and see who's who. All right, so here's the game plan. First, we'll do a super quick refresher on GDP, the main tool we're using to measure everything. Then we'll jet over to the US, which is just blowing past all expectations. After that, we'll compare that to Europe's much steadier, kind of slower pace, before we unpack this fascinating situation in Japan. And of course, at the end, we'll tie it all together and show you why these big numbers actually matter to all of us.
Okay, first things first. Before we can really get into the numbers, we all need to be on the same page about what we're even measuring.
Whenever you hear economists or financial news anchors talking about the economy, there's always one key number they turn to first. It's like the economy's main vital sign. And that number is gross domestic product, or GDP. At its core, it's just the total value of all the goods and services a country produces and sells over a set period. The best way to think about it, it's like an official report card for the economy. A bigger number means things are growing and healthy. Simple as that.
All right, now that we've got our key term down, let's look at our first report card. And wow, is it a big one coming out of the United States?
Just take a second to look at that number. In the third quarter, the U.S. economy grew at a staggering 4.3% annualized rate. Now, what that means is, if the economy kept up this pace for a whole year, that's the growth you'd see. It's a huge sign of economic momentum. Now, to really get why this is such a big deal, you have to see what everyone thought was going to happen. The experts, the analysts, they were all forecasting a pretty solid 3.3%. But the actual result? 4.3%. It didn't just beat the forecast, it absolutely smashed it. So where did all this extra economic juice come from? Well, the data points to two main engines. First, a big jump in consumer spending. That's you and me and everyone else buying stuff. And second, a really strong performance in exports. So this wasn't just some statistical fluke. It was powered by real people and real businesses doing more.
Okay, so let's hop across the Atlantic now to Europe, because the picture there is, well, it's very different. The story here is one of slow and steady moderation.
This chart really tells the story, doesn't it? I mean, look at that towering bar for the US at 4.3%. Remember, that's an annualized rate, just like the UK's 1.3% figure. But then you look over at the broader EU, which grew 0.4% just for the quarter itself. The takeaway is crystal clear. While the US is hitting the accelerator, Europe is expanding at a much more gentle pace.
And digging into that UK number, the 1.3% was important precisely because it wasn't a surprise. It landed exactly where everyone expected it to. And that tells us that the UK economy is stable, sure, but it's also a bit subdued, probably feeling the pinch from higher interest rates.
You don't have to take my word for it. This analysis from investing.com really hits the nail on the head. Because the data just met expectations, it had a neutral impact on the British pound. It basically confirmed what traders already knew. Steady, moderate growth. So no reason to make any big, sudden moves.
All right, get ready for a fascinating plot twist in our global checkup. We're shifting our focus over to Japan, where the most interesting economic story right now isn't about the rate of growth at all. It's about a totally different kind of measurement.
That number, 24, isn't a percentage. It's a ranking. Japan now ranks 24th out of 38 developed nations when it comes to per capita GDP. That's a pretty big slip, and it's actually their lowest ranking since they started tracking this way back in 1994.
So here's the puzzle, right? The average economic output for each person in Japan fell 2 spots in the global rankings. But, and this is the key part, it's not because their economy is shrinking. No way! It's still the 4th largest in the entire world. The main reason for the drop is the weakening yen. See, these rankings are all calculated in US dollars, so when the yen's value drops against the dollar value of Japan's output also drops, even if the actual amount of yen being produced stays the same. Okay, so we have the US rocketing ahead, Europe on a steady stroll, and Japan navigating this really interesting currency-driven puzzle. So what? What does any of this actually mean for the real world? Let's connect the dots.
It really all boils down to 3 huge things. First, currency impact. An economy that's growing strong, like the US, tends to have a stronger currency. Second, investor sentiment. Those kinds of blowout surprise numbers we saw in the US, they act like a giant magnet for global investment, pulling money into the country's markets. And third, and this is a big one, central bank policy. This data directly feeds into the decisions those banks make about raising or lowering interest rates, which, as you know, affects everything from your mortgage to your car loan.
And all of this leaves us with one final forward-looking question. We're clearly seeing the world's major economies taking very different paths. This divergence is setting the stage for a really fascinating year ahead, and it all comes down to this. As these economic tracks keep separating, who's going to be able to adapt the fastest? We'll definitely be watching. Thanks for joining me.